You keep your hard-earned money in the bank because you are afraid of losing it. But what if I told you that there are places to put your money that are safer than banks and also pay you more than your bank? Today's video features successful author, investor, and businessman Robert Kiyosaki, who will reveal why you need to get rid of cash to buy the two best assets that will secure your financial future during these difficult times.
The world economy is heading into the worst economic headwinds since World War II.
So, why does Kiyosaki believe you should withdraw all of your funds from your bank? Let's take a look at the Fed. The Federal Reserve establishes target interest rates at which banks lend to one another over the course of a day in order to maintain reserve requirements. Similar to the hike in February, the Federal Reserve raised the benchmark federal funds rate by 25 basis points this month to a new target range of 4.75% to 5%, raising borrowing rates to their highest level since 2007. Robert Kiyosaki is not the type to remain silent on Federal Reserve policies. In a tweet last week, the financial expert targeted the Fed, claiming that the institution's approach of raising interest rates will crash equities, bonds, real estate, and the US dollar, causing a $1 quadrillion or $1,000 trillion drop in the derivatives market. Kiyosaki recently accused Jerome Powell, the chair of the Federal Reserve of the United States, of being dishonest about how interest rate increases will affect inflation. Kiyosaki predicted a further rise in inflation based on how the United States handled the financial crisis following the sudden demise of three lenders, Signature Bank, Silicon Valley Bank, and Silvergate Bank, in a matter of days. He claimed that the US would likely increase its money printing to bail out the banks, resulting in higher inflation. In fact, Robert Kiyosaki disputed President Joe Biden's claim that bailing out failed banks would not cost taxpayers money. Despite all this, Kiyosaki remained concerned about the economy and the American taxpayers. He believes that the Federal Reserve and the FDIC's constant creation of false money, referring to the dollar, was a sign of hyperinflation. According to Kiyosaki, the current financial crisis, which has already claimed Silicon Valley Bank and Signature Bank, will cause inflation to rise once more, even if it has been falling in recent months. According to data released on March 14 by the Bureau of Labor Statistics, BLS, the Consumer Price Index, fell to 6% in February, continuing the downward trend in consumer inflation. The Housing Index, which accounted for 70% of the increase, was a major contributor to the still high inflation, even though inflation has fallen for the seventh month in a row. The Federal Reserve's 2% inflation target remains unattainable. The news was closely watched as one of the final economic indicators before the Fed meeting last week. Meanwhile, the closures of Silicon Valley Bank and Signature Bank have created havoc in the local banking sector. There has been increasing pressure on the regulator to hold off on raising interest rates in order to avoid further stress on other banks and work to stabilize the industry.
They pump out fake money. The purpose of central banks like the Fed is to protect the banks, not you.
According to Jamie Cox, managing partner at Harris Financial Group, the Fed will have to pick its poison. Tolerate some inflation for a while to see if the Fed's current series of rate hikes take effect and pause, or continue hiking and deal with the financial instability caused by their policy decisions. Following the announcement of the rate hike, stocks rose slightly. The Dow Jones Industrial Average fell 531 points, or 1.63%, as the major indices finished in the red. The Nasdaq fell 1.6%, while the S&P 500 fell 1.65%. So, what does this imply for you and me? And how will it affect us? Number 1. The Fed rate boosts savings account and certificate of deposit (CD) rates. Even if you can't borrow as cheaply as you used to, rising interest rates still have some advantages, particularly for savers. Finally, banks raise yields to attract additional deposits. Higher interest rates imply higher earnings for people who like to put their money into bank savings accounts. According to national bank rate statistics, the average savings interest rate increased over the last year from 0.6% to 0.23% as of March 15. Number 2. Rising mortgage rates. Borrowers may rush to complete a transaction for a fixed loan rate on a new home if they notice signs of a rate increase. However, because interest rates are a significant factor in mortgage rates, they frequently track the yield on domestic 10-year Treasury notes. As a result, as interest rates fall, so will mortgage rates. Lower mortgage rates reduce the cost of purchasing a home, so this will impact home sales across the entire USA. Number 3. Residential transactions. When interest rates and inflation rise, demand for homes often falls. On a 30-year loan, at 4.65% for example, homebuyers can expect to pay at least 60% of their investment in interest. However, if interest rates fall, the same house at the same price will have lower monthly payments and less interest paid overall over the life of the mortgage. When mortgage rates fall, the exact property becomes more affordable, so buyers will be excited to start scooping up property. Number 4. Bonds and stocks. Lower interest rates have a direct impact on the bond market. With yields on everything from US Treasuries to corporate bonds falling, this makes them less appealing to new investors. Bond prices move in the opposite direction of interest rates, so as interest rates fall, bond prices rise. Similarly, rising interest rates reduce bond prices. Fixed income investors are suffering as a result. People are less likely to borrow or refinance existing debts as interest rates rise because it is more expensive to do so. Also, as interest rates rise, investors' portfolios may shift from stocks to bonds or fixed income assets, as these investments become more appealing when investors sell their equities. As a result, the stock market could fall. 5. Using a credit card becomes more expensive. When the Federal Reserve raises interest rates, your credit card debt becomes more expensive. This is because credit card companies' interest rates usually closely track the federal interest rate. With the pathetic interest rates offered by financial institutions on checking and savings accounts since the Great Recession, keeping money in a bank or credit union is basically like keeping cash under your mattress. It loses value fast. So, what are your options? Are there any safe havens that can protect you? Yup, here are a few. Number 1. Buy some short-term bonds. Take advantage of bonds now more than ever if you're 5 to 10 years or less away from achieving a significant goal, such as retirement or sending your children to college. As a result, your portfolio's total risk is lower, and the income generated by your portfolio is more stable. Number 2. Finance your home. It makes sense to lock in. It is prudent to keep your fixed income portfolio liquid and your mortgage rate at the current level before it rises. If you are qualified, now is the best time to refinance your home to lock in the lower payments. Number 3. Pay off your debts. Because of higher interest rates, the variable interest rates on your outstanding amounts will rise. If you want to live a debt-free life, paying off that type of debt makes financial sense as interest rates rise. Number 4. Invest in inflation protection, gold and silver. Kiyosaki advises against putting money in the bank right now. He recommends investing in precious metals, such as gold and silver, as the best substitute for counterfeit money. Gold has outperformed paper money and other valuables over time. Gold is viewed as a means for people to preserve and pass on their wealth from generation to generation. People have cherished the unique properties of precious metals since the dawn of time, when the dollar depreciates against other currencies, as it did from 1998 to 2008. Long-term investors, such as those who subscribe to the financial vault, frequently turn to gold for safety. As a result, gold prices rise. Add silver to your portfolio too, if you want to invest in a less expensive asset than gold. Because silver and gold have been accepted as legal tender for so long, they are unlikely to lose value anytime soon. My father was a survivor of the 2008 recession. Due to the 2008 financial crisis, the world experienced falling prices and the threat of a depression. At the time, government bond prices rose significantly, and yields fell as a result. He used the treasury bond to invest $10,000 of his life savings in the bank. He then spent half of what he had on 6 ounces of gold at a cost of $973.66 per ounce, for a total of $5,841.96. He still had $4,158.04 in his account, which he used to pay my college fees, clear debts, and pay for the utilities in our home. What made this story stand out? The treasury bond has returned 6.89% of his total investment, and gold has risen to $1970 per ounce. Another person who profited from the recession was Jamie Dimon, a billionaire and banker who, despite not being an authentic individual investor, made significant gains for JP Morgan during the credit crisis. Diamond used the strength of his bank's balance sheet to buy Bear Stearns in Washington Mutual at the height of the financial crisis. Two financial institutions that had made large bets on the housing market in the United States were destroyed. JP Morgan purchased Bear Stearns in early March 2008 for $10 per share, or approximately 15% of its worth. That same September, it also purchased WAMU. A portion of WAMU's value from earlier in the year was also reflected in the purchase price. JP Morgan shares have more than quadrupled in value since their lows in March 2009, making shareholders and its CEO extremely wealthy. Dimon is well known for avoiding many of the pitfalls associated with the subprime mortgage crisis of 2007-2008, which devastated several competing companies. When dealing with rising interest rates, all investors should be cautious, especially those nearing retirement. As with any other market situation, the best way to mitigate the impact of rising interest rates is to strike the proper asset allocation between gold, silver, and treasury bonds. Rich people put their money to work for them because they understand that money must be converted into something of actual value in order to be valuable. They spend money by investing it in businesses that will generate cash flow over time. For everyday people like you and me, the best way to protect ourselves from financial turmoil is to add extra streams of passive income. My favorite passive income business is linked in the description below. Click the link in the description to take a 15-day challenge that will explain everything. My dad invested $15,841 15 years ago, and the value has since doubled. Why put your money in a bank where it will depreciate when you can invest it in assets that will increase its value? In my next video, I'll introduce you to another financial expert who will reveal some strategies for increasing your income during economic downturns. This expert will reveal the secrets that wealthy people use to increase their income during economic downturns without sacrificing their lifestyle, changing professions, or making significant changes in their spending habits.